So, Happy New Year. At last, we've come to the end of a really challenging, really crazy 2020 and looking forward to the new year of 2021. So, at the end of every year, it's really important to do a review on your investment performance and to look ahead into 2021 to see, all right, what can I expect for the new year? So, the first thing is here's my report card. At the end of every year, I always show my report card, my performance to my community, to my students, and you can see that for the year ending, year to date, one of my portfolios, this is my US portfolio, is up 50.72%, and the other one over here, yep, year to date is up 56.41%. So is that good or not good? Well, it's always good to have a benchmark, and my benchmark is always the S&P 500 index. Because I tell people that if you don't know how to invest, all you gotta do is to just buy the index ETF and close your eyes, and you just get market returns. So in the last 100 years, the S&P 500 ETF, or the S&P 500 to be specific, has returned about 9 to 10% a year. In other words, even if you have no investing knowledge, you just buy the index ETF, you should be getting 9 to 10% a year. So as investors, our job is to beat the index, to get more than the index returns. This year, the S&P 500, or rather in 2020, the S&P 500 ended up 16% return. So if you can beat a 16% return, it means that you have beaten the stock market in 2020. So a 50% return to a 56% return is above the benchmark. So I'm pretty happy with that. Now, do bear in mind that this year has been an exceptional year, or rather the year that just passed. Like I said, in the long run, the S&P 500 delivers about 9 to 10% a year. So this year, which is a 16% return on the S&P, is way above the average. So don't expect this to happen every single year. It will not happen every year. So I'm not surprised that in the year to come, or in a few years to come, the returns of the index should be lower in order to move towards its long-term mean average of 9 to 10%. And I tell people that when the index is up so much, anyone can make money. A blind, one-legged monkey could make money. So don't be too happy if you made a lot of money this year, because it was really easy to make money this year. But on certain years, if the index is negative or the index is only like 5%, it becomes more challenging to get higher returns on your portfolio. Now in 2020, not all markets did well. So the US did really well, Shanghai did really well, but Hong Kong was down. The Hong Kong market is down 3%, and the Singapore stock market is down 11%. So there's a huge divergence, right? Now, in my Asian portfolio, where I mainly hold Singapore banks and Singapore REITs, that's mainly for dividends, okay? And I'm pretty happy with that performance. Let me just show you my portfolio, and this is my Asian portfolio, okay? So for the year, you can see that I'm up 13%. Now you may say, only 13%? That's embarrassing, all right? But remember, these are my Singapore stocks and some of the Hong Kong stocks I buy for dividends, right? So over here, you can see this is the Hong Kong ETF, and that's another Hong Kong ETF. This is the Hong Kong Exchange. This is Meituan. This is Ping An Insurance. This is Ascendus REIT. Escort REIT. So I've got a lot of REITs in this account, all right? And the reason I'm pretty happy with this 13% return, first of all, this is only the capital gains. In this portfolio, I collect a lot of dividends, and the dividends is roughly about 4 to 5% a year. So if I include the dividends, 4% plus 13% is a 17% return. Now, given the fact that the Singapore market is down 11% and the Hong Kong market is down 3%, and I managed to get 17%, I'm pretty happy, all right? So again, always compare yourself with the index, the benchmark. If you beat the index, you have done well for this year. Now, for those of you who are in the chat groups, you know that in the last couple of days, you have had countless messages and emails from really happy students saying that they've done so well in 2020. It's the best year they've ever had. And really, I see some spectacular results. And, a lot of Vietnamese tend to be doing really well. All right. So like Tony over here is up 215% in 2020. We've got Andy, who is a very, very new student. He's up 150% for the year. We have got another Vietnamese, Chung, who's up 2,787%. Damn, right? But think about it. If you take a look at his drawdowns, there was one stage he was down 75%. So I'm going to talk about that in a short while. That if you're going for those huge returns, be prepared for huge volatility. Okay. You've got Bagus Utomo, who has been following me for 10 years. He took my course 10 years ago, and he has beaten the market almost every single year. And the last 2 years, he's up 372%. Amazing stuff, right? You've got Alex up 55%. You've got Gilberto up 82%. You've got some crazy results. This lady up 90%. Right, Dr. Chan, all the way from Malaysia, up 54%, Mary up about 40%, and so on and so forth, right? So I'm really happy for you guys. I'd like to thank you for sharing because it inspires the community, inspires me. But again, let me remind you that this will not happen every single year. It's not every year you get a 50%, 80% return. 2020 was exceptional because the market itself went up 16%. So when the market goes up, double digits, a blind monkey could make money. And of course, it's easier to get huge returns in this market. It will not happen every single year. Again, remember that in the long run, the stock index delivers 9 to 10%. So like I said, this 2020 was way above the average, and it can't go on, right? Expect the next few years that the market will still be positive, but it should revert downwards towards the mean. Okay, so just be careful of that. And I know that I've got emails from students who were disappointed. They say, Adam, I only got a 15% return, I only got 20% return, but these guys are getting 90%, 100%. It's unfair. Why? Right? Now, let me just tell you that never ever compare yourself to another investor or trader. Well, before that, let me just say this, right? Again, remember this. If you have beaten the index this year, if you have gotten more than 16%, you are already one of the best investors in the world. Be proud of yourself. Why? Statistics have shown that in any given year, less than 10% of professional money managers, of professional fund managers beat the market. Less than 10%. In fact, the world's largest hedge fund, which is Bridgewater, run by billionaire Ray Dalio, one of the best investors in the world, and also run by some of the smartest brains in finance, their main fund is down 18.6% as of November 2020. So if you have beaten the market this year, you are among the best investors in the world. Okay? Now, the other reason why you should never compare with someone with 100% or 1,000% return is because you don't know the kind of risk or leverage that that person took to get those returns. For example, if you want to get an 80 or 97% return, you have to take a lot more risk. For example, you may have to take more leverage in your account. You may have to take a higher risk per trade in your trading portfolio. You may have to have a more concentrated portfolio of only growth stocks. You may have to buy even more speculative stocks. Like, there are people who say to me, Adam, it's no big deal what you've done. I bought Tesla and I'm up like 400% this year. I bought NIO and I bought all these really speculative growth stocks, right? And fine, right? But I'll never buy those stocks because those stocks are too risky. They're overvalued. They're too speculative, right? So the point is, remember, if you want to get very high returns, you got to take a lot of risk. And if you do that, it could go the other way. So here's a rule of thumb. For every 1% of return that you want to get in a year, you must be prepared for 0.5% of downside volatility. Okay, so for me, on any given year, I'm only willing to see my money drop by about 20 to 25%. That's what we call a drawdown. Remember that your money does not go up in a straight line. Your account doesn't grow every day, every week, every month, right? Your account goes this way, goes up and down and up and down, right? This is what happens in your account, like the markets. And this is what we call drawdowns. That to get to the promised land, you got to go through some turbulence, right? So like I said, for every 1% return you want to get in a year, you must be prepared for your account to drop 0.5% along the journey. So for me, like I said, I'm only willing to see a maximum drop of 25% drawdowns. And that's why at the end of the year, I'm getting about 50 to 60% returns. So for fellow investors who have been getting an 80 or 100% return on their portfolio, they must have been willing to tolerate a 50% or 40% drawdown along that journey. Now, I'm personally not willing to tolerate such volatility. So it all depends on you. You must always invest based on your own personality. Now, there are some people who are even more conservative than me. They say, Adam, I'm not willing to see more than a 5 to 10% drop in my account. That's fine. So if you're not willing to see a 5 to 10% volatility, then you should not expect more than a 10 to 20% return a year. So there's no right or wrong. Again, as long as you make money every single year, as long as you beat the index, as long as you invest in a way where you have minimal volatility, minimum risk, and maximum return, you've done your job as an investor. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.